Okay, so a last minute addition to our 2022 revision programme. I've been asked to have a look at this Zelta frames question. It's a combination of marginal costing, standard costing, some reconciliations of budget to actual profit figures, and a little bit of writing at the end. So this was a 32-mark question from the ACCN4 paper in June 2016, but this could just as easily be kind of fashioned into a 20-mark section B question under the new specification, maybe with a few less tasks in there. But anyway, let's have a little look at the information. So Zelta Frames manufactures window frames. The company operates a system of marginal costing. So remember, that's all going to be about contribution. And the standard cost data for one window frame is as follows. I apologise, it's a bit dark this evening, and I have put the link to this paper, so you should be able to get a copy of the question if it's not completely clear. But it tells us that the direct materials, 15 metres of wood, at £1.80 a metre. Okay, so that 15 metres is your standard quantity for one window, and the £1.80 per metre is the standard price for 1 metre of material. But the total cost, because we're looking at variable costs here, we're going to have to work out the contribution in a sec. 15 metres of wood at £1.80 is going to give you £27 per window frame. We can do the same with the labour. So direct labour, 1.5 hours, that's the standard hours for one window. £8.40 per hour is the standard rate. Well, if we multiply those two together, 1.5 times 8.40, got to be 12.60. So those are your variable costs. Okay. The budgeted information is given to us for a whole year, ended the 31st of December 2016. We need to be a bit careful here because in a minute we're going to be asked to work out some figures just for the month of March. So it's telling us about inventory of finished goods and direct materials, but it tells us a bit down here about the fact that inventory levels remain constant. If you remember, marginal costing, one of its flaws is that it doesn't deal with variations in levels of inventory. It's not very good at inventory, but we can actually just kind of ignore these figures. I'm just going to put a little line through there. Because actually it doesn't matter if the inventory levels don't change, we can just ignore them. They're already there at the beginning, they'll be there at the end, so nothing's changing as far as we're concerned. But the sales, we are interested in that. They expect to sell 22,200 units. So what we need to do is divide that by 12. So 22,200, let's just divide that by 12, is 1,850 units per month. And it does tell us under here that production and sales are spread evenly over the year. So if we make that in the year, just for the month of March, we should be making 1,850. And this is the standard price for sales. Obviously, this up here is the standard price for the cost of materials, but the standard price, £55 a unit. Okay. The other piece of information we're going to need to pick out of here is that the annual fixed overheads were budgeted to be 108,000. Well, if we divide that by 12, that gives us overheads of £9,000 per month. Okay, so we've got to calculate the budgeted contribution and the budgeted profit. So remember, contribution is your selling price, which in this case is £55, minus the variable costs, which are up there, £27 and £12.60. So the contribution per unit is going to be, what does that work out? £15.40 per unit. So budgeted contribution is going to be £15.40 times the number of units we expect to make and sell, 1,850 units. So that's going to give us a figure of 28,490. So that's the budgeted contribution. To get to profit, we've just got to knock off the fixed cost. Don't try and take off the whole 108,000. Remember, it's just the £9,000 for the month, and that's going to give us our budgeted profit. Okay, difference between 28,490 and 9,000 is what? 19,490. Okay, so that is, I mean, they're saying 5 marks. I don't think it'll be 5 marks under the new scheme by any stretch of the imagination. The other thing we had to do, I think, for part B, oh yeah, seems a lot of space there just to do a little calculation. I was worried I'd missed something then. So for part B, we're given some actual results. So over here, if you recall, we've already established things like the standard price, the standard rate, and standard quantity and standard hours for 1 unit of output. Now, this is a classic question where we are going to need to flex. And I know everybody's terrified of the word flex, but don't panic, keep your hair on. find out what the situation is for 1 unit of output, and then flex it or multiply it by the number you actually made. Now this 1,850 down here, the number of units we expect to make, is actually irrelevant for any of the cost variances. The only time we're ever going to need that is if we have to calculate a sales volume variance, and we don't even have to do that in this question. They've already sorted that bit out for us. So let's have a look then. So the actual results for the month of March were as follows. The sales, they actually made 1,900 units. So that's the actual quantity for sales, okay? And that's the actual price there, £57 for sales. Then they tell us that they've used 29,260 metres of wood that cost 57,057. Well, as a total, that's not a great deal of help to us, but if we can divide the 57,057 by the number of metres, that gives us a cost of £1.90 per metre. And that's actually going to be your standard price, okay, for materials, not for sales. And then we can do the same with labour. They use 3,040 hours, costing 26,296. So that actually works out, I've already done the maths here, £8.65 an hour, and that's going to be your standard rate. Actual fixed overheads were £9,000. There was no variance there. That was as expected, and we're not required to do fixed overhead variances or variable overhead variances in our syllabus. So that's one bonus. Things could always be worse, people. Right, I'm going to calculate the actual contribution and the actual profit for March using just these figures up here. Now, what we could do is work out, divide all of this by 1,900 to work out a contribution per unit. But I'm going to suggest we just go on a total. So sales in total, we made sales of 1,900 units, and each one was sold for £57. So if we do 1,900 times 57, that gives us 108,300. Okay, then we can just take off the variable costs as a whole. So we can take off the materials, let's pop those in there, 57,057, and we can do the same with the labour. The total cost of labour was 26,296. So that gives us the actual contribution. So we do the 108,300 minus these two, that leaves us with 24,947. Okay, then we can take off the fixed costs, the overheads, actually cost £9,000, so exactly as budgeted, and that's going to give us the actual profit for the month of March, which is going to be, 15,947. Okay, so if you remember, we had budgeted profits. I've lost my bit of paper. Budgeted profit over there, 19,490. Actual profit for the year, 15,947. Okay, so now what they're asking us to do is calculate the subvariances for direct materials and direct labour. So remember, the subvariances for materials, it's price and usage, and for direct labour, it's the labour rate variance and the labour efficiency. Okay, so if we're thinking about materials, let's think about what we actually need. So with materials, we're going to need 4 things essentially. We're going to need to know what the standard price for materials was. So the standard price is £1.80 a metre. Okay, we can then look and see if we can find the actual price. Well, yeah, we worked it out up here with £1.95. So the actual price, move that up a bit, is £1.95 per metre. Okay, and that's per metre as well. And then the standard quantity, remember I said to you, find the standard quantity for one. Well, they've given it to us up here. It's 15 metres, but it needs to be multiplied by the number of units we actually made. So 15 metres times 1,900 units is going to give us, what will that work out? 15 metres times that, 28,500. Let's just write that, just say 15 metres times 1,900 units, just because 15 metres times 1,900 units is 28,500 metres. And then the actual quantity is the last one we need. Actual quantity used was 29,260. Okay, so we can now work out the materials price variance. I'm going to kind of try and squash all of this in here. Materials price variance is the standard price minus the actual price, and that's multiplied by the actual quantity used. So the standard price is £1.80, the actual price £1.95. what we've worked out here and what's come from here and on the previous page. And then we're multiplying that by the actual quantity, which was 29,260 metres. So I'm going to end up writing in the margins where it says do not write outside the box. So £1.80 minus £1.95 times 29,260 means that I've got a negative in my calculator, 4389, which you can see that there. That means it's an adverse variance. So when we're doing cost variances, a negative in your calculator is adverse, and a positive in your calculator is favourable. Okay, now the materials usage, remember it's the standard quantity. It's the standard quantity that we've already flexed up here, minus the actual quantity times by the standard price. So standard quantity, 28,500 metres. Actual quantity, 29,260 metres. And we're multiplying it by the standard price, which is £1.80. So 28,500 minus 29,260 times £1.80 gives us 1368. 1368 adverse. Okay, just to show you that. Again, I've got a minus on my calculator. You can see there. It's an adverse variance. Okay, now I'm not going to fit the labour on there. Let's do the labour on a different sheet. So the labour variances then, for labour, we need to know the standard rate, and we need to compare that with the actual rate. So the standard rate, go back to these bits of paper over here, the standard rate of labour is £8.40 per hour. Okay, the actual rate is what we actually paid them, which is on this sheet, £8.65, we worked out there. And then we need to know the standard hours. Remember, we need to flex the standard hours. So let's go back to the standard. So the standard hours is 1.5 hours per window times the 1,900 units that we actually made. Okay. So standard hours, 1.5 times 1,900 is 2,850 hours. And we're going to be able to compare that with the actual hours, which was 3,040. Okay, so now we've got that, it should be an absolute doddle to just work out our variances. So for the labour rate variance, remember it's the standard rate minus the actual rate times the actual hours. So the standard rate of labour, £8.40, minus the actual rate, £8.65, times the actual hours, 3,040. Let's just do that. So £8.40 minus £8.65 times 3040, and too quickly, too fast, too furious, a minus of 760. That's going to be adverse. Remember, you have to label these variances up. Labour efficiency, I should probably be putting pound signs as well if I was doing it properly, but let's remember this is the night before the exam and we're in a rush. Labour efficiency then, standard hours, remember it's the flex standard hours minus the actual hours, and that's times by this standard rate. So standard hours flexed for actual output, 1.5 hours per window times 1,900 windows gives us 2,850 hours. Actual hours, 3,040, times it by the standard rate, which was £8.40. Let's just do that then. 2,850 minus 3,040 times £8.40. So that gives us 1,596 adverse. Okay, so again, there was a minus in the calculator just to prove that one. Right, so we can now move on then to section D. Let's just check that we're, yeah, so we now got to calculate the sales price variance. So the sales price variance, the formula for that one is the standard price minus the actual price times the actual quantity sold. With the standard price, go back to the first page. Sorry, that's the second page. Let's go back to the first page. £55, I think, from memory. There it is. £55 is the standard price. The actual price, I think, was 57, wasn't it? There we go. £57 up there. Times the actual quantity sold, which if you remember was 1,900. That's what we based all the flexed units. Now we need to be a bit careful here because we've actually sold it for a higher price. Okay, so if we did it this way round, we get a minus of 2 times 1900 units is 3800, but it's not adverse this time because we're doing a sales variance. It's the other way round. When we're doing cost variances up here, higher is bad. Higher number of hours, higher amount paid to the staff, higher amount paid for materials, all that kind of stuff. High is bad when it comes to cost, but obviously when it's selling price, that's a good thing. So we've got a £3,800 favourable variance. Now, it doesn't ask us to do this, but we could actually calculate the sales volume variance as well. I'm just going to remind you about this one because I just want to show you the difference between the sales volume variance and what we actually include in a profit reconciliation. Now, the sales volume variance is the standard quantity. So remember, this is the only time you ever need standard quantity. So the planned level of output, as it is, was 1,850. That's the only time we're ever going to use that planned level of output minus the actual quantity, which was 1,900, and we're timesing that by the standard price, which was £55 a unit. Okay, so we've sold 50 units more at standard price of £55, actually equals a £2,750 favourable variance. But we are not going to get all of that money. If we go back to here and we look at the budgeted contribution, it's only £15.40. So the increase in profit will be £15.40 budgeted contribution times the number of extra units, 50 units. So £15.40 times 50 units is £770. It's still favourable because we've sold more units than we planned, but we're not going to add all of that lot to profit. That's just the overall volume variance. We're actually only going to add 770 because we've got to pay for the extra raw materials and extra labour. Okay, hopefully you're all still with it. We're going at breakneck speed here so that you can all get a nice early night before your big day of exams tomorrow. Right, so the next thing we've got to do then is it tells us that the accountant has calculated that as a result of the actual sales volume being in excess of the budgeted sales volume, additional contribution of 770 will be gained. So they're not expecting you this time to calculate it, which is quite kind, and that's what I've just shown you how to calculate. Now, if we go back here, now this sort of question is quite high risk because if you've messed it up at the start, you're going to have problems when you get to this bit. But can I just urge you to shove in as many of the figures as you've been able to calculate? So even if you know it's wrong or you didn't manage to do this bit, but you've got some of the other figures, stick them in because it's worth 7 marks in total. That's not going to be 7 marks for getting the right answer overall. It's going to be, individual marks, getting things going in the right direction, potential own figure marks and all the rest of it. So let's start with the budgeted profit, 19,490. Okay, and what we could do is just shove the figure in straight at the bottom, the actual profit we worked out, 15,947. So we can see that overall profit has gone down by quite a bit, about £3,000 or £4,000. So we're going to be expecting, because we've got the adverse variances, obviously an adverse variance will reduce profit. Okay, so the sales variance, let's stick that one in first. We've just worked that out. Should be on my most recent piece of paper. So the sales price variance there, 3,800 favourable. We're going to add both of those. Okay, they're both favourable variances. A favourable variance will increase profit based on the budgeted compared to the actual. Whereas all the cost variances, I believe, we just calculated were adverse, weren't they? We had 4,389 and 1,368 on the materials. So 4,389 adverse. So we're going to take that one away. And 1,368 also adverse on the material usage. So they will both reduce profit. If we were doing this based on cost, we'd be adding an adverse variance because it would increase cost and deducting a favourable variance. If we were doing a cost reconciliation, we wouldn't see anything to do with sales because it is purely cost, so revenue doesn't have any place in a cost reconciliation. But back to this one, if we look at the labour variances, they were both adverse, 760 and 1596. So let's take those away. Okay, now we've put that figure in, but we probably ought to check it. I'm not sure whether it's advisable to check it in the exam. Maybe, I don't know, leave it up to you. Do you check that your statement of financial position adds up when you finish that? I think I would, but you can spend an awful lot of time looking for a difference, can't you? Okay, so phew, that is correct. So that does actually agree. We've actually managed to do the reconciliation. Okay, so then there's just one little bit here. We've got 4 marks stating 4 benefits of maintaining a system of standard costing. Okay, so what do we know about standard costing? It's where we set the costs in advance. So the price, we set the selling price, we set costs for costs and quantities for materials and labour. So what it should do is enable a system of controlling costs to take place. So it gives us a benchmark. So it tells us what the situation ought to be, and then we can use that to compare what actually happens. So we could use it for target setting. We can use it to encourage people to minimize wastage, be more efficient, that kind of thing. It does act as an effective tool for planning and particularly controlling, because we can do the variance analysis and see what's gone wrong, and we can actually start digging deeper. Why did we have a material price variance? Was it an external factor? And we don't want to go too off piece with this one because it was only worth a mark a piece. But let me just pop the magic answer rather than me just waffling on at you. You can read that. Let's actually see if we can put a bit more light on that. Sorry, the focus isn't brilliant. But yeah, you can see there, you can have a look at that, the possible answers. Okay, so hopefully you've enjoyed that. Good luck for tomorrow. Try and get a good night's sleep. Don't panic, keep calm, and enjoy your 3 hours of accounting paper 2 tomorrow. Thanks for watching.